Imagine turning a modest $10,000 investment into a life-changing $300,000 without having to spend hours every day analyzing charts, timing the market, or stressing over complex trading strategies. Here at Sam Invests, we know that the biggest myth in wealth building is that you need to hustle day and night or take massive risks to achieve financial freedom. The true secret lies in a lazy, passive, and highly efficient approach using compound interest, index funds, and long-term holding strategies that do the heavy lifting for you while you focus on what really matters in life. In today's video, we are going to break down the exact, step-by-step blueprint that both beginner and experienced investors can use to let their money work for them, transforming a $10,000 starting point into a $300,000 portfolio on complete autopilot. Part 1. The power of compound interest. The foundation of turning a modest initial sum into a massive fortune relies entirely on understanding how compound interest works. Compound interest is the process where you earn interest on both your original money and the interest you have already accumulated over time. This creates a snowball effect, meaning your wealth grows at an accelerating rate rather than a linear one. When you invest $10,000 in the stock market through a broad index fund and leave it untouched, the returns generate more returns. Over a period of 20 or 30 years, this exponential growth is what allows a seemingly small investment to multiply 30 times over without requiring any extra effort on your part. To put this into perspective, imagine investing the $10,000 and earning an average annual return of 8%, which is roughly the historical average of the stock market. In the first few years, the gains might seem small, but the magic happens when the interest begins compounding. After 10 years, your initial investment more than doubles, but after 30 years, it reaches well over $100,000 without adding another single penny to the account. If you combine compound interest with regular contributions, the growth becomes even more aggressive. The key variable in this equation is time, which is why starting as early as possible gives your wealth the runway it needs to achieve massive gains. Taking action on this means you need to adopt a hands-off approach and let your investments grow in the background. Many beginner investors make the mistake of checking their portfolios daily and trying to time the market, which disrupts the compounding process through fees and missed days in the market. Your main goal is to identify a reliable low-cost index fund that tracks the broader market. Invest your capital, and then let compound interest do the heavy lifting. You must resist the urge to take out the profits during market downturns, as staying invested through the volatility is exactly how the compounding engine continues to run. Part 2. Selecting the best long-term index funds. The cornerstone of the lazy wealth building strategy involves choosing index funds that track broad market indexes like the S&P 500 or the total stock market. An index fund functions as a massive basket of stocks that represents the performance of the entire market, which automatically grants instant diversification and minimizes the risk of individual company failure. For beginners and intermediate investors alike, this means you do not need to spend countless hours trying to pick individual winning stocks or predicting market movements. By placing your $10,000 into a reliable and low-cost fund, you are effectively betting on the long-term growth and productivity of the entire United States economy. When selecting the right fund, you need to pay close attention to the expense ratio, which is the annual management fee charged by the fund provider. For instance, reputable funds, such as the Vanguard 500 Index Fund or the Fidelity 500 Index Fund, offer extremely low expense ratios, often near 0%. This low cost is crucial because even a small fraction of a percent difference can eat into your compounding returns over a period of 30 years. Advanced investors might also look to diversify internationally by adding a total international stock market index fund to their portfolio, ensuring they capture global economic growth alongside their core American holdings. Taking action means logging into your brokerage account, searching for a broad market index fund or exchange-traded fund, and setting up an automated purchase system. You do not need a complicated trading dashboard or expensive financial advisors to execute this step. You simply choose the broad index fund that aligns with your risk tolerance, commit your starting capital, and prepare to hold the assets for the long haul. Building wealth the lazy way means removing the emotional stress of trading and relying on the time-tested performance of the largest and most stable companies in the world. Part 3. The mechanics of dollar-cost averaging. The strategy of dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of the fluctuating price of the asset. This technique helps remove the psychological pressure of timing the market and prevents you from trying to guess the absolute bottom or top of a stock price. When the market is down and prices are lower, your fixed investment amount buys more shares, and when the market is up, it buys fewer shares. Over the long run, this averages out the purchase price of your portfolio, reducing the overall impact of short-term market volatility on your wealth. Applying this mechanism to your investment journey means you do not have to worry about putting all your money into the market during a single risky day. Instead, you maintain a consistent buying schedule that smooths out the average cost per share over multiple years. For example, by committing a portion of your income or a set amount from your initial capital on a monthly basis, you ensure your portfolio continues to grow regardless of daily, weekly, or monthly price swings. This continuous accumulation is especially powerful during market corrections or bear markets, where your money is effectively purchasing assets at a discount without requiring you to time the bottom. To put this mechanism into action, you should navigate to your brokerage account and establish an automatic, recurring transfer from your checking account into your chosen index fund. By setting up these automated instructions, you remove the emotional friction of deciding when to buy, protecting yourself from impulsive financial decisions during turbulent market periods. This consistent, mechanical accumulation is the cornerstone of building wealth with minimal effort, allowing you to confidently progress toward your $300,000 goal while remaining focused on your primary daily activities. Part 4. Reinvesting dividends to accelerate growth. When you invest in broad index funds, the underlying companies often distribute a portion of their earnings back to shareholders in the form of dividends. For the lazy investor aiming to turn a moderate sum into a substantial fortune, taking the cash payout is a major missed opportunity. Instead of pocketing this money, setting up your portfolio to automatically reinvest these dividends allows you to purchase additional shares of the fund without spending any extra cash out of pocket. This creates a secondary compounding loop where your original investment and your monthly contributions are joined by the power of dividend reinvestment, accelerating your timeline to the $300,000 mark. The mechanism behind this is known as the Dividend Reinvestment Plan, or DRIP for short, which is a feature offered by almost all major brokerage platforms. When a dividend is paid, the broker immediately uses that cash to buy more shares or fractional shares of the same fund at the current market price. This approach is highly beneficial because it removes the temptation to spend the cash on non-essential items and keeps your capital fully deployed in the market at all times. Intermediate and advanced investors recognize that reinvesting dividends is equivalent to buying more assets on sale during market dips, maximizing the exponential growth of the portfolio over the decades. To take immediate action on this strategy, you must check the settings inside your brokerage account for every stock or fund you own and ensure the dividend reinvestment option is toggled to on. Many platforms set the default to deposit cash into your account balance, so you need to proactively change this preference to reinvest. Once this is set, the process runs completely in the background without requiring any further decisions or manual intervention from your side, ensuring every dollar is constantly working to generate further returns. Part 5. Optimizing taxes and minimizing investment fees. When you are looking to grow $10,000 into $300,000 over the long term, taxes and investment fees act as a silent tax on your wealth. The most effective way to shield your compounding growth from the Internal Revenue Service is to utilize tax-advantaged accounts such as a Roth IRA, traditional IRA, or a workplace retirement plan like a 401k. By investing within these designated accounts, your capital gains and dividends can grow without being taxed annually, or, in the case of a Roth account, they can be withdrawn entirely tax-free during your retirement. Failing to account for tax efficiency can cost you tens of thousands of dollars over a 30-year investment horizon, which makes choosing the right account type just as important as choosing the asset itself. In addition to taxes, investment fees can severely damage the compounding process if you are not careful about the funds you select. Many mutual funds and professionally managed portfolios carry high expense ratios and front-end loads that eat into your returns, reducing the amount of capital working for you. A seemingly small expense ratio of 1% might not seem like much today, but over a multi-decade period, it can consume nearly 20% of your total potential wealth. To avoid this wealth reduction, you should focus on low-cost index funds or exchange-traded funds that carry expense ratios of less than 0.1%, ensuring that virtually all of your gains remain in your portfolio. To put these optimization strategies into action, you should review the account types available to you and consider transferring your taxable brokerage investments into an individual retirement account if you qualify. You should also check the expense ratios of the funds currently in your portfolio and swap out high-fee mutual funds for low-cost index equivalents. By taking control of the fees you pay and leveraging the tax structures provided by the government, you retain maximum capital that continues to compound until it reaches your ultimate wealth goals. Turning a modest $10,000 into $300,000 doesn't require you to spend hours every day trading or trying to beat the market. Instead, it is about harnessing the quiet, unstoppable power of compound interest, low-cost index funds, and automated consistency. By letting your money grow on autopilot, reinvesting your dividends, and protecting your wealth from unnecessary fees and taxes, you set yourself up for long-term financial freedom without the daily stress. If you found this lazy wealth-building strategy valuable and want to continue growing your financial knowledge, make sure to subscribe to the channel so you never miss our upcoming videos. To let me know that you are ready to put this blueprint into action, leave a comment down below with the phrase, "Compound interest is my best friend," and I will see you in the next video.